With all the central banks apparently coordinated to get us out of this financial mess, surely everything's going to go well and we've got the green light to buy stocks. Not so fast, says my next guest. He's the founder of Elliott Wave International. He's Bob Prechter. Bob, you say this is a period much like 29 to 33. How so?
Well, one of the big things that happened in 1929 was that a consortium of the biggest banks in the country tried to stop the stock market from going down. They failed. Ultimately, it went down very hard, and then there was a recovery, and people said, okay, it's over with, and we finally are past the worst. We have a very similar setup here. Central banks were fighting the decline in 2008, 2009. In fact, very few people remember that it was in December of 07 that the central banks first got together and started promising unlimited credit. And that didn't stop the market from going down 50% plus. What we have that's different, though, and I think this is what's keeping people off balance, is that the banks these days are much bigger than they were in 1929. Back then, they were regular banks. They had their depositors' money they could bet with. And now we have central banks. They not only can create money by buying debt, but they can also pledge future taxpayers' money as well. So they're much, much bigger. But I think as we've seen in the last 5 years, they're really failing to keep things afloat because all they have to offer is credit.
But in fairness, let's break this down a little bit. It's lasted longer than the 29 to 33. Was it not sufficient for us to just get beaten like a red-headed stepchild in terms of 2007 and 8? We went down very nearly 50%, give or take, in fact, more. And we've recovered since then. Wouldn't that put us somewhere around 37 when we were in that recession and then came out of it by kicking up World War II?
Yeah, history, as they say, repeats, but not exactly. You can look at it as the kind of recovery we had into April of 1930, which I think is very, very similar. And we said, by the way, back in March of 2009, get ready. We've had 5 waves down under the Elliott Wave model. We're going to have a very big bear market rally. And when it's over, the economy is going to be in recovery, or appear to be. The Fed's going to take credit for saving everybody. But it's just a big bear market rally. Be ready for that. And I think that's where we are today. You can also liken it to 1937 as well. And then there was another leg down into 1942. However I look at it, all of the technical indicators to me agree. Whether I'm looking at patterns, the sentiment indicators, or the momentum indicators, are all saying the same thing. This has been a bear market rally. The bear market's not over. There's another wave coming. So you want to be cautious.
And perhaps the biggest concern, at least from where I'm sitting, and you focus on, the socioeconomics of this, meaning the societal mood and how that's going to play itself out. We've got growing discontentment throughout Europe for understandable reasons. How does that play into the Occupy Wall Street? You name it, there's disgruntled folks everywhere. Is that going to be a restriction for the market highs in terms of this rally?
Well, bear markets, I think, are born of trends toward negative social mood, just as bull markets are positive social mood trends. And they have consequences. People don't only buy stocks, they also expand their businesses in a positive mood trend. They celebrate in ways that express that positive mood. When the trend turns the other way, you get the opposite. People start selling stocks, they start getting more cautious, they pull in their horns on their businesses, and it shows up a little bit later as a recession. And we've also seen it expressed in terms of anger in a lot of different ways. We've had these protests throughout Europe, we've had regime changes, bloody regime changes in the Middle East, and now we're having Occupy Wall Street in the United States. So these are the kind of things, using an Elliott Wave socioeconomics type of model, that you can anticipate, be well ahead of. Other people think that these are causes. So they look at the news and they say, well, what does this mean for stocks? As far as we're concerned, it's already months late, because the downtrend in stocks, or the beginning of a downtrend, already said, look out for these kind of signs, and these are results, not causes.
And is there anything we can do, or anything that would encourage you to flip this thing around? We've got the central banks, we've got a lot of folks trying to prop up confidence. You're skeptical, I'm skeptical, but are we going to see a little bit of an upturn? Are we going to see an abatement in this negative mood swing before it gets really worse?
Well, when we came into 2011, the most striking thing that was going on was that there were 2 very strongly believed themes. One was by all the people who are bullish. They said, we're in a recovery, it's slow, but everything's going to be great. A lot of people made highly leveraged bets on that recovery, and they got hurt quite a bit. The stock market, in terms of the broad averages, such as the Russell 2000 and the Value Line Index, is down 5%. Foreign markets are down 10% on average in dollar terms. That's been a bad bet. Commodities are down about 6% on the year. That was a bad bet. The only thing that the bulls did not want to touch was the same thing the bears didn't want to touch, because most bears were hyperinflationists. They said you need to buy gold, you need to protect yourself with commodities and so on. Both camps didn't want bonds, and bonds are the only thing that had a great year, 18% plus total return on the year so far. Most people weren't interested, but to me, they fit the deflationary scenario because bonds have been going up now for years and years as we've been in this disinflationary environment. And I think we're very close to that cusp where we're going to roll again. We got a hint of it in 2008, but I think the big deflation is coming in the next 4 or 5 years. And that's when we'll wipe the slate clean, get rid of all the bad debt, and start over again.
All right, it's going to be a while, but we're going to clean the slate, start all over again. Things aren't that dour, at least not in the big picture. Thanks so much. He's Bob Prechter, founder of Elliott Wave International.